What's up, everybody? I finally got a morning upload for you. It's pretty much impossible for me otherwise, so it always comes out late at night when everyone's already asleep. But regardless, we're doing a morning upload. I'm going to talk about Aitx, that's Artificial Intelligence Technology Solutions Incorporated. And we're going to go into the 400% increase in revenue and also a couple words of caution for you. But first, I'm going to show you guys a clip by the CEO mentioning a little something about dilution. So that's the first part's going to be a negative, and then I'm going to bring in the clip that's a positive. So stay tuned here.
Listen, let's start with one fact.
Okay.
Business is hard.
Yeah.
Most aren't going to be around in 10 years. That's just typical business. Whether you're on the OTC or you're opening up a car wash or you're opening up a restaurant, you're opening whatever it is, right? Things change. We're already 5-6 years in, so we're doing pretty good so far.
Yeah.
Okay. Now, if you really want to make a judgment on if there's some toxic dilution at work in a company, I would look at the statements. This is what I do. I look at the quarterlies and the annual filings, and I look for notes. Every one of those notes has the ability to be toxic.
Okay.
I'm not saying that they are. I'm just saying that if you're seeing a long series of notes, which we used to have,
Okay.
there is a possibility that some of them can lead to significant dilution.
Alright guys, so as the CEO just said, you got to look into the notes and see the little details. So we're going to do just that now, and let's get into it. Now, first off, a negative. He said to go into the notes, so that's just what we're going to do. And you'll see here we have a going concern. Now they go to tell you that for the 6 months ended August 31st, the company had a negative cash flow from operating activities of $6,096,000. The company has an accumulated deficit of $72 million, a negative working capital of $2,600,000. Management does not anticipate having positive cash flow from operations in the near future, and these factors raise a substantial doubt about the company's ability to continue as a going concern for the 12 months following the issuance of these financial statements. You will see here that the company does not have the resources at this time to repay its credit and debt obligations. They are in massive debt. We can all see this, and I will show you. I'll show you the statements here in a second. Without additional capital, the company will not be able to remain in business. Okay, now that is just screaming dilution is coming. And these companies, they do, it's something that does happen and they do need this to happen. But just be aware that, there's going to be dilution coming. This is practically written in stone. I definitely see this coming. Like, yes, it's great that they're up 400% in revenue, but they're still operating at a loss. So, the devil's in the details. It makes a great headline to see that it's up 400%, but you got to look into the little details. So here we have more info on dilution. In the near term, management plans to raise an additional $15 million to $50 million before the end of the fiscal year. So that's going to be coming up here. And their fiscal year, I believe, ends in February. I could be wrong there. Management is committed to raise either non-dilutive funds or minimally dilutive funds. There is no assurance that these funds will be able to be raised, nor can we provide assurance that these possible raises may not have dilutive effects. But as a positive, the company currently projects that 2022 fiscal year's revenue will be between 5 and 15 times greater than 2021's fiscal year revenue. And that's a good sign there. But, of course, there is no assurance that the revenue will increase to the extent projected, or that the anticipated improvements will actually occur. And this expansion plan does require the company to add more resources, meaning hiring more staff. They expect to finish the next year with between 75 to 125 employees. So just, like the CEO said, you got to look into the notes. And, of course, I will leave a link to all this stuff. Now, I'm no financial wizard, okay, but when you look at the assets, you can compare assets to liabilities. That gives you a good idea of what's going on with the business. So their assets have been gaining, so that's a good sign. Total assets of $5,451,000 as compared to $1,500,000 in February 28, 2021. So that's good to see that. But when you look at liabilities, the liabilities have also increased as well, but they've increased by a little under double, whereas the assets have actually increased almost 4 times. So that's good. That's, in my opinion, good to see. But yeah, the elephant in the room definitely is that the liabilities and the fact that they're in quite a bit of debt, okay? And, there's a reason it's an over-the-counter. This is the kind of nature of these kinds of stocks. It is a risk. Now, I do currently have a small position. I didn't buy on the run up. I am not buying yet. I know it's down quite a bit today. We are down 11% today. And, it was to be expected on the huge run up. From where were just a couple days ago, we had about an 87% run. So it's obviously to be expected that we're going to have a drop. So far, 21% from the tippy top. And I do see this coming down a little bit more. And because at least in terms of patterns, if you want to look at the pattern, every time we have a huge run up, not every time, but most times when we have a huge run up, we'll pop, come back down, and pretty much break right where we were previously. And it doesn't happen every single time. Like here, this was kind of just a falling knife, it looked like. But right here, same kind of deal. We had a pop, came back down, pretty much broke just about break even from where that pop came from. And now we are up again. If you're considering getting this one, I can't tell you what to do, but I do highly recommend keeping an eye on it, being cautious, taking your sweet time on this one. Always take your time, do your DD. Don't just stop here. There's all kinds of more things you can read. I will leave you guys the SEC filings. Read it for yourselves. Get familiar with these numbers. The more and more you check these things and read them, the easier it becomes for you. I promise you that. And now, when you look at this, it had a huge, huge, huge spike up to about 28 cents, and ever since then we have just been dropping. We're hanging out at like the 2 to 4 cent range. So I mean, yeah, there's a possibility that it can rally a lot, but there's also a possibility that this can be, this company can die just based on huge debt, and there is going to be a lot of dilution, so keep that in mind. That will be a future negative effect, and it is coming soon in my opinion. Now that the negatives out of the way, we're actually gonna get into some positives, and I want to actually roll another clip that the CEO mentioned about being in with a couple of the top 25 global companies. And let's roll the clip.
People respond to when big companies mention companies like yours. So like, for example, if Amazon said we're going to use the product at our facilities, like all of a sudden everybody's a believer. Why do you think people respond like that? Because to me, if you know what you own, you don't need Amazon to be the reason that all of a sudden you want to be in the stock.
Well, first of all, 3 of America's top 25, the global's top 25 companies are our customers. And if any one of those names got out, you would have what you're, calling what I'll call the Amazon effect, right?
Yeah.
But we can't talk about it.
Yeah.
But I know that if we did, the stock would reflect good things. Let's